Hello, chart watchers and Decision Point faithful. Welcome to this May 2nd, 2022 Decision Point show. My name is Erin Swenlin from DecisionPoint.com, and I am here with my father, Carl Swenlin. We're here to give you our insights as we move into this week of trading, which is already starting off in a very interesting way, I'd have to say. Dad, how are you doing?
Good, suffering from whiplash.
Yeah. That seems to be the case with the market these days. Very, very strange movement, but we'll go over those charts and indicators and let you know what we're thinking about the market. Carl's going to start out with his grab bag of just interesting things that he's noticing. He's going to also do our market overview and look at the indicators. I'm going to concentrate on two terrible sectors. And from that, I'm going to give you my diamonds of the week. I have two for you after looking at those two terrible sectors. So we'll move forward from there and check out. First of all, I have a live trading room on Mondays at noon Eastern. It's free to sign up for it. If you just go to our website, you'll see the ad for the Decision Point free trading room, and you can just click on it and then register. You only have to register once. It's recurring every week on Mondays that you'll get notice when it's getting ready to start. And of course, if you're on my free newsletter list, you will also get the recording for those free trading rooms. I suggest you check it out, see if it's something that interests you. I thought we would start off with our signal tables, Dad. Not looking so great out there as far as the market table goes.
Right. And that was not up to date.
Oh, no, I have the one from April 29th. I guess it changed.
Yeah. There's the diamonds is intermediate term neutral, and New York Stock Exchange composite is long-term sell.
Okay, that's New York, yeah, right there. So it's just going from bad to worse, I guess would be what we're saying. This one should be up to date, unless we had some signal changes today.
No, I don't recall any today.
Nope. So really, as you can see, the biggest areas of weakness would be technology. Not a big surprise there. I think everybody's familiar with that going south. And of course, communication services, followed by consumer discretionary. These three are probably the most aggressive sectors out there, and they tend to lead the market in one direction or the other. And with them doing so poorly, it's certainly put a lot of downside pressure on this current market situation. So let's go ahead and look at some charts. So I'm going to pass it to you to get us started with your grab bag.
Okay. And let's get that out of the way. What we had today was an interesting situation. It kind of started low and then rallied and then went steadily downward. I thought that's where we were going to end up, or that or lower. I left the house to go get your mother right here. And when I got back, it was up, and I had no idea what in the world was going on. And I checked all the three financial news outlets that I have, and they didn't have any idea either. In fact, two of them didn't even mention it. So it's just another bear market issue right now. I think it's just, what I think is that the crash prevention team has come to town, and I think they're going to try to keep this market from going too much lower. Let's see what we have. Got a good support right in through here. When I was thinking we might find some support on that line right here. So that's good. But if you want my opinion, and this is my opinion, it's not a forecast, but I think that the market is going to go down probably 60 or 70% from the all-time high. That's what I think before we're all done with it. There's just so many things that are no good, that are wrong, and it's just a matter of time and more of this herky-jerky action that we have to go through. In our, let's see, is that the one? No, that's not the one either.
We get all our charts ready, and then there you go.
Yeah, and that's, yeah. Anyhow, we did a little article on the 6-month seasonality having changed, looking at the last 2 6-month periods. This was an unfavorable period, and the market went up 11%. And here's a favorable period, and it ended up going from there to here, and so it was down 10%. So seasonality, there are certain things that go on a regular basis in the different 6-month periods, one of which would be summer vacations. People go away, they don't want to trade, they're not paying attention to the market. That's just one of them. But if you really would like to get into the kind of things that work on the market, I recommend the book Riding the Bear by Cy Harding, the late Cy Harding. It's a really good rundown, and he has a suggestion about how to deal with it. I'm not selling his trading system per se, but I think if you want to know what seasonality really means, you should read that book. And my next issue here is relative rotation graph charts. Mm-hmm. Okay. I think this is a really cool idea that Julius came up with, but it's a relative rotation. Relative to what? Well, in this, you have a choice of benchmark. In this chart, this is SPY. So if the SPY is going down like it was for the last 5 days, that's what we're set at 5 trading days. And if any of these sectors are not going down as fast as the S&P 500, then they're going to show favorably on the chart. But to me, when the market's going down, I don't want to do better than the market per se. I want to do better than losing money. One way to tell is it just you pick a benchmark. They have StockCharts has $ONE, which is basically an index that doesn't change. So it's all the relative rotation is checked against an index that stays the same, and you can see the difference. This is the same result, the same chart. I mean, the same group, but we're seeing there's really not anything with relative strength here. Possibly XLP and XLRV, but weakening doesn't attract me either.
No.
So if this is what I would do. I mean, I'm not saying it's good for everybody, but if the market's going down, then I want to see the stuff I'm buying is not going down, that it's actually improving. Right.
Which right now, none of them are.
No, they're not. Let me see if still the same. Yeah, it's a little, yeah. Anyhow, so done with that. Let's try the next thing. SPY versus RSP. There we go. Mm-hmm. This is the performance chart, RSP being an equal weighted S&P 500 index. And we can see that, and I'll tell you, this is from the all-time high over here. Normally, when the market starts going down in a big way, the equal weighted actually moves faster downward than the weighted, the S&P 500, the cap weighted index. In this case, we're seeing that the cap weighted is beating them out. And I've been thinking about it, and I think the most thing, probably the reason is that these darlings, these cap-weighted darlings just got way too overpriced, and they're just making up for it right now. There was, let me see, one of the stars of the stock picking last year was Kathy Wood, and RRGs for the ARK Innovation ETF. And this year, she's not been doing that well. This is just what happens. You know, people that come out at the top of that list generally won't do as well the next year because, you know, this is just, there's made some fortunate guesses and we'll say educated and that turned out to be good picks. But this year she's not doing well at all, which, you know, that's just life. There is another fund, ARKK. This is short.
It's a short for that fund.
That's a short for the ARK fund. So they're looking really great now.
Not a good day, but yeah.
Right. But, you know, just an interesting little tidbit. Okay, bonds. I got a really long-term chart of bonds here. And you can see up and away. I think that, you know, we have broken that trend line. And I think that move is going to continue down. Here's the reciprocal, and that's the yield on those bonds, and that broke out as well. I guess I better get over to checking the market. Okay, say it's almost a hammer here, which means hammering a bottom. We'll see. I don't have any faith in the bullish formations now or signals. They're likely to just not do that well. Let's look at new highs and new lows. An expansion of new lows today. Intraday, as I remind people, this is intraday new lows. And even though the market closed up, we register those lows intraday.
Yeah, I don't see any positive divergences there yet.
No. That's not what I wanted. Let's see. Climax assessment. We didn't get any climaxes today. Kind of close on net AD volume, but look at net AD is very tiny. Today was, I just think, a temporary aberration. We're looking at notice the 200 EMA, and here's the 50 coming out to it. So this week, unless there's some really radical rallying, I think we're going to get a death cross on this SPY and on the diamonds, the DIA, I should say. The short-term indicators. This is one of the technical source of why we may have rallied today. Is they got really oversold, and we're due for a short-term bounce. So that's a possibility there. And our intermediate term indicators, the ITVM, they're still not oversold enough, in my opinion. But you can see this could be enough if we're only going to, if this sell-off is going to run out of steam. But I'm looking for readings more down in here. Bitcoin, not doing that well. And Charlie Munger and Warren Buffett are getting all kind of static because they hate Bitcoin. They hate the cryptos. I want to look at the 10-year yields are headed higher. I just don't, we get some pullback, but I just think they're bound to be going higher. They're looking for a 50 basis point rate hike from the Fed on Wednesday. And I don't see any reason why they would not do that, because we certainly need it.
Mm-hmm.
The dollar kind of consolidating here short term. And gold is not doing that well, thanks to the dollar. But we've got a 20 about ready to cross over the 50 here, so we're about ready to go neutral on gold. I've been watching that. It's tried to rally today, but it couldn't get to it.
No, actually, we gapped down there.
Yeah,
You can barely see it.
I'm sorry.
Yeah.
I made a note to tell myself, don't forget it's down here. Yeah, okay. It was off quite a bit. I think the futures are showing it down to like over 2.5%, but that's I think has to do with that, the futures rolling over something. But anyway, this is what, if you're holding gold, that's what you're ended up with right here. Not good.
No.
Well, I've been waiting for the gold. If it's going to go lower, I'm going to get some more.
Yeah.
I think ultimately that's going to be the winner. Here's USO, was down lower today, but finished higher. And again, I think oil is got nowhere to go but up, and bonds going lower. And just you can see you got a line that was over here, and then it's more accelerated, now more accelerated. It's not as tight a filling wedge, so it's probably not. I don't think it's going to break out of that wedge higher. I think it's going to go out of it lower. Just a guess.
Yeah.
And I think that'll do it.
All right. Okay. Well, I'm going to go with, we've talked about how bearish everything looks. I thought I would give a really good example of how bearish it is. Honestly, that RRG that you showed against $1 really is a reflection of what we're seeing on the PMO on all of the sectors right now. None of the sectors have rising PMOs. That might have happened today on comm services. I doubt it. Yeah, it's flat, so it's still not rising. So, when you look at the momentum picture in all of these sectors, it's a pretty ugly look. So one of the things I'm noticing when I do my DecisionPoint Diamonds report is the last 2 weeks we decided to go more on short positions and inverse ETFs, and it's been a big winner for diamonds to go into that area. So I'm actually starting to research a little bit more on some of the inverse ETFs that are out there. And so what I wanted to do is I looked on Friday to find honestly what I thought were the worst sectors. And when it came right down to it, XLK has been a bad sector, but it's hitting support. It seems to be, if we have a bear market rally, that's probably where we're going to see it happen. I mean, obviously utilities look pretty bad, just price wise, you can see. But on Thursday, I went with an inverse on real estate, and that obviously turned out to be really good going in on it on Thursday. So that was one of the inverse ETFs that I looked at. And the other one was an inverse on healthcare, which is actually one that I found today in the trading room. I asked around. I couldn't find, with my very brief search on StockCharts, an inverse for healthcare, but I did end up finding one. But you can see that dark cross just about ready to happen. And support, really strong support, is still pretty low. Same with real estate. But when you go in and look under the hood, as we like to say, at participation, I think it becomes even more clear how weak these sectors are and how much weaker they are getting. What I was looking for were silver cross indexes and golden cross indexes that had percentages much higher than the participation of stocks above their 20, 50, and 200. So one of those was healthcare. And as I said, it lost the 200-day EMA Friday, and now it has lost it, traded mostly below it. And at this point, from where the price is to the next level of support is about 5%, a little less than 5%. But really, the strong support is all the way down here. And that's about 8.5% is where the next level of support is. So that one I thought was particularly ugly, just based on, you can see relative strength hasn't been that bad, but it's been performing in line with the S&P. And as you were just saying, and as I've been letting all of my subscribers know, because I use relative strength analysis, right now, you want something that's not doing as well as that benchmark, because that benchmark is really doing poorly. So being in line with that benchmark isn't going to help you. So we want to find stocks that are not only performing in line with the SPY, but are starting to lose that position. Not so much on healthcare yet, as far as the relative strength. But again, I was trying to find a group that had had really great participation and was starting to really fade as far as the silver cross and golden cross. I mean, when you look at these percentages of participation under the surface for healthcare, it's a pretty ugly picture. And the other one that I was looking at was real estate. And like I said, we put an inverse real estate ETF on right here. And since then, just based on the close, it's a 7% gain on that loss there. But I'm going to show you the inverse ETF, and you're going to love that. So again, here we have, fading silver cross and golden cross index. The golden cross is staying about the same. But look at how high these percentages are. But compared to the participation of stocks above their 20 and 50 and 200s, particularly the 20 and 50, those percentages are very, very low. So that tells me that we have a sector that was actually somewhat healthy. It's now unhealthy and getting less and less healthy. So that's one of the reasons I was looking at real estate as far as an inverse. So let me show you those inverses. And it is, there's the pro shares, ultra short real estate. So this one, you can see that's where we put the trade on, was right here. And you can see that it's definitely doing all the right things. I put in stop levels on all of my diamonds when I present them, and you can see all the good things that were going on. In fact, that arrow is pointing here because that's where stochastics were when we picked this, and we'd already gotten that crossover buy signal. So there were a lot of things telling me that this particular short ETF would be good, but it's an ultra short, meaning it's 2 to 3 times. I think this one might actually be 3 times short on real estate. So you really, when you go with something like this, you really have to have some conviction as to where it's going to go. But I like this. The next level of overhead resistance is up here, and that's 13.5% away. And I think we can get there. So I think this one looks pretty good. And then the other one, I don't have it marked up, because this is the one that was presented to me as an inverse. The only issue I have is the volume is extraordinarily low on this one. Its average is only 13,000. So keep that in mind when you get into something that is that low. It's very easy for that to get manipulated as far as price goes. But being that it's an inverse of a particular sector, I think it's, it's not, I wouldn't say safe, but I was okay with presenting this. And you can see that we had that break above the 200-day, ended up closing just below the 200-day, actually on the 200-day EMA. It's looking pretty good for that breakout. And to overhead resistance up here is about 9.75% upside potential on this particular one. This one is also ultra short. So you have to, again, consider that, and the fact that you have to have conviction before you get into some of these ultra short type ETFs. So that was really what I wanted to concentrate on. But since we were looking at some of these inverses, one that was brought to my attention also in the trading room amongst my folks is the Ultra Pro short of the Dow 30. This one also looks pretty good. When we go and look at, let's go ahead and just look at the sector, the industrial sector here, because that'll be helpful too. You can see we had just gotten a death cross here on XLI. Obviously, PMO is in terrible shape. The only thing that kind of, I won't say concerns me, but when I'm thinking about going on an inverse ETF, particularly an inverse like that, we are looking at XLI hitting some support here. So you could actually end up seeing a bit of a bounce off that support level. But overall, when you look under the surface at the participation percentages, you know that there aren't a lot of stocks doing well. You can see that XLI was outperforming the S&P for some time, but it's now in line with the S&P. Well, that's worked out well for it, hasn't it? So since then, it's been in line with the S&P. So there you go. It's at the same level as our quote unquote benchmark, and that's just not good enough right now. You also mentioned something earlier, and I can't remember which chart it was, but something to keep in mind as far as bear market rules, because we were talking about that. Let me go over here. I still have about a minute and a half. So one of the things that we talk about when we get into a bear market or bear market rules, and one of the things that people love to show me in the trading rooms, and honestly, the things that I look for in a bull market anyway, are reversals. I like to get those beat down stocks that are getting ready to make the turn and make some money off of that. But the problem is, like we were just looking at the comparison with the benchmark, the problem is reversals usually happen when a 50-day EMA is well beneath the 200-day. Let me look at NVIDIA, because that's been a popular one. And I got 45 seconds, but I'll get my point across here. So people are looking for the reversal here, right? It's not on support. It's actually dropped below support. Things are starting to look a little bit up for it. But the problem is it's in a bear market of, let's see, it lost 46% from this high to this low. It's in a bear market. So looking for it to reverse, looking for those bullish expectations, you're probably going to get burned. So what I've been concentrating on are continuation patterns, like we were looking at on USO and that symmetrical triangle. We expect the breakout to the upside. So that's what I would be concentrating on. I would avoid reversals. That's all we have time for. Thank you for joining us. Good luck and good trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.